Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts as they share with you the insider's guide to property investing.
All right, folks, you're on the Property Couch, your insider's guide to property investing. I'm Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel. And he's Ben Kingsley, the chair of the Property Investment Professionals of Australia and the 2014 and 2015 Property Investment Advisor of the Year. Hello, mate.
G'day, buddy.
How are you?
Very well.
We've got a very special guest today. We get lots and lots of tax questions, and you and I dodge them like the plague because we're not allowed to answer them. So we brought someone on who can actually answer them. Frank Azzopardi, partner of YK Partners here in Melbourne. And mate, we thought we'd get you on to talk all things property related. So welcome to the couch.
Thank you. Thanks for having me.
Pleasure. Mate, as I said before, Ben and I often, we have a go at answering them, don't we, mate? But we always put our big disclaimer up and pretend that we're...
But also in our business, I mean, at the end of the day, it's one of the areas that it's a critical part of the conversation. You've heard us talk before about, we don't invest for tax benefits. It's a tertiary benefit. It's not the primary reason or the secondary reason we do that. Growth and income, they're the things we're looking for in terms of, but it's a big part of it. So structure, strategy. So we thought we'll start at the top and then work down in terms of some of the important things. And these are the guys that we refer to in our business, and they're great at what they do. So we thought we'd get Frank on.
Exactly. So I'll kick it off, mate. We get lots of people talking to us about, to be honest, a lot of people buy property in their own name. But quite often we get people that want to put it, within a trust or partnership. Should I buy it with a
seminar?
mate?
And they're being told this is what you need to do.
So we thought we'd kick it off. Tax 101.
Yes.
Mate, I guess the pros and the cons of each of the structures. So probably the most common, Ben, wouldn't you think, is someone who wants to put it in a trust?
Trusts, okay. Well, look, trusts are they're useful vehicles for particular ventures. It depends what you're doing. With regard to properties, it always depends on whether the property is positively geared or negatively geared.
Yeah.
If you're in the realms of buying a property that's negatively geared, buying it in a trust is not tax effective because of the fact that obviously you're looking for the tax deduction in your return, essentially.
Yeah.
Trusts do not allow losses to be distributed out. They get caught within the trust until such time as there's actually profit to distribute. So it's like a through vehicle, essentially.
Yeah.
So from that perspective, as I said, most properties are negatively geared essentially to start with. So buying it in a trust doesn't really make any sense because you miss out on the tax deduction.
Do you find many, because that's so pay as you go, and that has a huge impact on them if they don't distribute those losses?
The trust, they miss out on the negative gearing and therefore reducing their taxable income as they normally would if they'd bought it, say, in their personal names. They'd get the offset against their taxable income to reduce the amount of tax that they need to pay.
Do you see many people who have the ability to say they earn their income through a trust themselves and then the ability to distribute? Do you see many property investors buy in a trust under that scenario?
Absolutely. If you're running a business through a trust and therefore have the means to distribute out profit from a trust into another trust, because the other thing you wouldn't do is put a property in a trust that already has an active asset in it, essentially a business, because you're exposing yourself from an insurance perspective and asset protection. So
part of what we do is make that flow through work.
Yeah, exactly. So the one trust would distribute to the other trust to absorb the loss, and therefore you're getting the benefit as you would do outside of the trust.
Mm. So wrapping that bit up, what you're basically saying is that if you've got a business and there's profits flowing through, and that could be a means to a family trust, because there's obviously discretionary trust and unit trust you might set up if you've got a partnership arrangement sort of going on. So what I'm reading, in what you're saying is, if I've got strong profits that potentially are going to flow through a business activity that I'm doing, I could potentially also have a secondary component of that can benefit from, if that's a negatively geared property in another structure.
Absolutely.
I can potentially have benefit from that.
So we can distribute from one to the other and use up the loss from that perspective, yes.
Yeah, PAYG, effectively it's like, well...
It's lost.
Yeah, they've already paid their tax, their PAYG tax, so where's the benefit? So obviously there is asset protection.
Yeah, there's asset protection. The only time it becomes beneficial is if the property is positively geared, and therefore you get the asset protection. It's in a trust, you get the discretion to distribute. If it's in a discretionary trust, you get the discretion to distribute where you want it to go, essentially within the family group. Other than that, that's it.
So what we see, and I'll put my Pippa hat on here, And what we see is spruikers and marketeers and people having fear campaigns around, someone tripped up a step and, there was a public liability claim and then they sued them and they lost all their portfolio. Now, you'd wonder, think there's a bit of an agenda for that. If they're running a tax business, they're sort of working on a 1 in 100,000 chance, a 1 in a million chance of happening, so they can potentially get a structure, which means that they can get ongoing fees for their business.
Generally, in my experience, it's always revenue raising, more so than looking after the actual interests of the client.
Correct.
And
that's why you need a form of view around whether or not you are genuinely in a litigious environment. So a doctor or a dentist or a lawyer, potentially genuinely in a litigious environment. But if you do a job where the likelihood of you being sued is so remote, you've got to weigh the cost versus the balance up. Because I remember doing property advising a lot before the GFC. And I was involved with a company at the time who was very, very strong in recommending people buy within a trust.
Right.
And so it sounds sexy at a seminar, and it sounds like if you make it a bit more complex, it just feels like you're doing more than the average person. But it had a flow-on effect to lending, because the listeners can't see, but this many lenders in your own name, and then this narrow amount of lenders when you do it in a trust. So it's not just a tax implication.
The other thing, that there is one other negative to investing in a trust, is the land tax surcharges that apply to if you buy in your own name and the property is above 250 in Victoria in value. There's obviously you get charged land tax. Yeah. If you've got it in a trust, you get hit with the land tax plus a surcharge. Yeah. So it's quite a steep bell curve. So.
And no capital gains exemptions.
In a trust? No. Capital gains tax exemptions do apply.
They
in
do?
A trust.
Great. Okay.
Company structures.
Which is a good segue into the next structure.
Companies.
So why would people think? I mean, we do. Clients come to me and say, "I've been told to buy it in a company." What would be the reason that I would buy a residential property in a company structure?
Asset protection is the only thing that really springs to mind. Other than that, you can't offset. Again, you've got to think of a company as a separate entity in its own right. So if it's got losses, the losses are quarantined within that company. Yep. Again, not being able to be used outside for PAYG earners. Yep. And it just gets caught there. So the other negative with regard to buying in a company, obviously, is, as we just touched upon, is the loss of access in the CGT exemptions.
Okay, that's the seat. Okay, and what about the land taxes there? What happens with land taxes?
No. It's just
Okay.
Now we sign a lot of contracts on behalf of clients in the name of a company, but of course it's a trustee company on behalf of a super fund, for example. And it's important to distinguish that in some cases people do buy within a company, but as long as it's on behalf as a trustee for something else.
Yeah, it's been non-beneficially held. Essentially, is the terminology we use. So generally, there's a corporate trustee that's set up above a trust, but it can be an individual trustee as well. But the more prudent way to set it up is from an asset protection perspective is to set up a company above the trust.
And it's such a hard job, guys, your listeners, because Frank's, when he's going through this process, there's permutations and combinations that are going on. And that's why, generally speaking, about tax is very difficult.
It is, and it all comes down to specific clients' needs and being in front of somebody and getting their whole story as opposed to just talking very general. Yeah. We can talk generally, but it's much easier to just talk one-on-one with somebody and get their whole picture, and then you can go, all right, well, actually, we can use this vehicle, or actually, no. Yeah. We're just going to do vanilla, investing in your own name. That's the best structure for you.
Keeping it simple and keeping the cost base down.
Absolutely, absolutely.
What about partnerships? The obvious one is husband and wife, and that's pretty easy to work out. But what about the partnership between mates or cousins or relatives? Have you got a view around buying property in partnerships outside of, say, the spousal arrangement?
Look, a partnership is a useful tool when it comes to investing in those scenarios, because of the fact that we can actually we can use the losses. So partnerships can distribute out whatever happens, whether it's profit or loss, out they go to whoever the partners are. And from that perspective, they're good. You don't come across too many people who invest outside their family groups, but...
So Frank, would you put a layer above? So let's say it's Bryce and I want to buy an investment property 50-50 with each other, okay? If we don't have that partnership structure at the top, effectively we've got joint and several liabilities. Yes. But does that partnership at the top protect that joint and several liability. In other words, if I fail to pay and Bryce is caught with this asset that is, we have a falling out in a mate's relationship, and all of a sudden I've just walked away from my commitment on that, and Bryce is sitting there going, "Wow, this is killing my credit history. I've got to keep servicing the loan."
Yep.
Does that partnership structure fix that, or is that more of the agreement, the legal agreement?
The legal agreement that's entered into is more pointed at this.
Pointed at that stuff. So it's not necessarily protecting that. There's still potentially joint and several liabilities in terms of what you're going in. So eyes wide open, guys, going into joint ventures and so forth.
Yep.
It's best to have a legal agreement. A partnership structure may not allow that, but the partnership structure just makes the clean cut of income and profits work smoother.
You still don't miss out on the negative gearing, which is obviously a big one.
Yep.
Now, in terms of the ownership, in terms of partnerships, you can have joint tenants and tenants in common.
Mm-hmm.
Joint tenants largely is the rule of survivorship applies, typically what husband and wife do, meaning the surviving partner automatically inherits the remaining share, versus tenants in common, which is a bit more like a business relationship where you could go 90%, 10%. Do you see that often, and how do you determine who gets the tax deductions on the tax return in situations where they are uneven?
Answers your first question. No, I don't. We don't see it overly often.
Mm-hmm.
With regard to who gets the tax deduction, it all comes down to who owns the property.
So if a client's confused about that, what's the document that you refer back to? Are you looking at the transfer of land document to see what the percentages
Pretty much,
are?
Yep. Yeah, it's as simple as that.
Okay, so I mean, effectively we've unpacked a bit of the structure stuff, and there's a lot more detail in that, guys. And again, go and speak to your professional, qualified, legal tax agent. Not just some people call themselves accountants, but they're not tax agents. Tax agents, you have to have a qualification, you have to have a number. And they're your true, chartered accountants, CPAs, those types of people are the best people to talk to, and they'll take you through that. But don't get caught up in these really complex structures. Don't get sold into this idea that by having, an angle, because a lot of these seminars and a lot of these spruikers, it's almost like, they're giving me the inside game. They're giving me the angle, and that's a scheme, and that's tax avoidance.
Absolutely.
Yeah, which is a big part of what we wanted to talk about, and it's probably a good segue into one of the other things we have a lot of conversation around, which is interest capitalising, and the famous Hart Case. So do you want to tell us a bit about that?
Well, the Hart Case was a long time ago
It
now.
was
but
a long time ago.
Essentially, what happened was the taxpayer got a split, what was called a split loan back then. I'm not sure it's still called a split loan.
Yeah, those still split loans.
Split loans. And the home was in one portion of the loan, and then he had an investment loan on the other side as part of it. So there's two loans, if you can think of that in your mind. And he, instead of paying down the investment loan, was literally just pumping all the money into the principal place of residence.
So the rent's coming straight into the principal loan. Yep.
And it was just the interest on the other side, instead of actually any repayments going there, it was just increasing, so capitalising.
Yep.
And the loan was increasing, and the interest was obviously increasing.
Yep.
From a tax deductible perspective, the tax office acknowledged that it was tax deductible, so Section 8-1 was applied and everyone was happy, but the tax office wasn't happy because they came in and applied what's called Part 4A, which is the anti-avoidance measures, because of the fact, to cut a long story short, they deemed the overriding benefit to be of a tax minimisation scheme, so they just applied Part 4A, which is just a very broad brush, and swept the previous ruling aside and said that it's anti-avoidance, so you can't capitalise interest.
So the take-out measure for that there for me is around that sort of principle, that if you do anything to avoid tax, in other words, if that's your dominant purpose, and you're setting up these structures for tax advantages, that's illegal, effectively. Absolutely. Under the Part 4A.
Yeah, there's ways to minimise tax.
Yeah,
but
legally.
Legally. But if you're trying to dodge tax by doing constructive things with loans and whatnot, and banks are out there and they're trying to be cute with particular products, and they always will be, and always have been. You just got to be mindful of the fact that if the primary benefit is to avoid paying tax or to minimise your tax, then the tax office will take a dim view of it.
And we're seeing this now federal level. We're seeing companies like Google and these big corporations who are setting up these complex structures in different tax jurisdictions around the world, ways of filtering marketing funds and trying to reduce profits so they pay less tax. So at the end of the day, if you're paying your fair share of tax, things should be fairly good for you. I mean, if it means you're creating wealth or something's going fairly well for you. So
it's a funny old conversation that we often find ourselves having with clients with regard to they don't want to pay tax, and you kind of have people come in going, yeah, I'm paying too much tax. It's like, well, you know what, you're actually paying tax because you're doing really well, and you need to flick your mindset into get into the tax world and pay the tax, and that means you're actually on track for you're doing well.
It comes to that negative gearing point, doesn't it? I mean, accountant might say, oh, look, you're paying too much tax, we need to get an investment property for you. Now, you need to get an investment property because you want to create wealth and a passive income. The tax stuff is also, that's fine. If there's a tertiary benefit where you're having a tax benefit outcome, that's even better. But then for that accountant to then go and say, so you need to go and buy something off the plan or get some type of huge depreciation schedule, that's going to be sexy for reducing tax. But you're buying a crap asset.
Yeah. Whenever I meet new clients and they're talking about investment properties, I quite often say that obviously I'm not going to advise you ever on which property to buy.
Yeah.
I can advise you around the structures and stuff, but go and see someone who actually knows what they're doing with regard to buying the property.
So you have to pay $1 to get 30 cents back and make a 70 cents loss doesn't.
No, it doesn't.
It's not the reason.
The next layer of the conversation always goes, well, as long as you've got a good property and the property is increasing in value, then you're okay. But if you've got a property that's just saving you 30 cents in the dollar and it's not increasing in value, right.
I always say to people at the end of the day, that tax refund that you get, you're not going to Maya. No, it's going into the prop up the property account. So,
but everyone's ears prick up at barbecues. Oh, what are you doing? You're minimising tax, or you got like, oh, there's this new thing. Oh, I'm into this new scheme, and it's going to be really great. And it's like, seriously. If too many people do it, trust me, they'll find it and they'll recover that tax.
Absolutely.
I always think, going back to uni, accounting 101, they always say, do whatever you can to avoid it, but don't evade it.
Yeah.
And if you get...
Good message.
That is a good message.
And, I've had clients in the past who have shown me pay slips, blue-collar workers, and they love bringing the pay slips and say, look, zero tax. They've paid zero tax and that's part of their goal. But as long as they've got the right asset and they've got the multiplier effect as well, because if they've got numerous properties to get that zero tax, it's employing the property manager. So it's actually adding to the tax revenue base. So, we've got to keep a bigger picture on this, but Ben and I are universal on this, and I'm sure you agree. Going into something for a tax benefit is just very short-minded thinking and short-sighted even.
Yeah, short-sighted.
Okay, so now the other big one that everyone sort of wants to understand is what we call the principal place of residence concession.
Yep.
So, and there's no real name for it in the Tax Act, is it? No. Everyone just refers to it as the 6-year rule.
Yeah.
So explain the 6-year rule to us.
Well, essentially, as long as you've got a principal place of residence that you are living in at a particular point in time, you move out and go and rent somewhere else for a period of time, you're allowed to call your old property your principal place of residence for a period of 6 years.
Yep.
And therefore not pay if after those 6 years you sold the property, there'd be no capital gains tax because it's still deemed to be your principal place of residence. You've got to bear in mind that you're only allowed to have one principal place of residence at any particular point in time.
Yep.
So you can't go and buy something, or you can go and buy something else, but you have to nominate. It's about nominating, and there's no forms or anything to nominate, but you have to basically
self-assessment.
Self-assessment.
When the ATO man comes, you've got to explain it.
The wonderful world of self-assessment.
Yes, we live in a self-assessment world in the tax world.
Yeah, absolutely. So you have to nominate whichever property you want as your principal place of residence.
Yep.
And you get, like I said, you get the 6-year exemption from capital gains tax. That's it in a nutshell.
And a lot of people think that, because we've had people come into the office and say, oh, I'm coming up to the 6 years, I need to sell the property because the property's gone up $100,000 as an example, and I don't want to miss out on that capital. It's like, no, you don't need to sell.
No, you don't.
That's just locked away. A lot of, so many people have said, no, don't sell. And it's sort of like, what, no, but doesn't it just evaporate? No, that's the moment in time. And for whatever reason, you've been dragged off to work in another state or across the other side of town, it's just more convenient to rent. You've locked that away.
Yep.
And so that was a good, and Jane and I have done it with one of our Sydney properties. We lived in Sydney for a while. We've got the 6-year rule, and again, we didn't sell. We made sure we got it valued at that time. And I think that's the tip. If you're coming up to roughly 6 years, you've obviously got your rates notice, or you can get an independent valuation, and then you just keep that on file.
Yep.
And that's again the self-assessment, you know, in terms of what it comes to.
And it also comes back to you can actually reset the 6-year rule as well, which is an interesting point.
Yeah, because I pressure tested you on that, and you came back to me and surprised me.
We've had this conversation, Bryce.
There you go. Tell the listeners.
Yeah, so you're able to. The 6-year rule is not applicable once on a property, so you can basically have 6 years, and you can reset that 6 years by moving back into the property. But it's a question of fact. So you literally have to move in hook, line, and sinker.
Yeah.
So change all your mailing addresses, banks, driver's license, move in in its entirety.
Yeah.
Live there for a period of time. There's no set time, hard and fast rule with regard to time, but 6 months, a year would probably suffice, as long as everything's changed. As long as you have actually moved back in, and that's factual, then you can reset that 6 year.
Keep part 4A in mind.
Yeah. I had a client recently
Always
who
lingering.
did that, single female, mid-40s, came in and said, look, I'm renting at the moment, but I have a lovely big home. I've lived out of that home for a period of time. I'm going to try and move back into it. But she was sort of hedging her bets in the sense that she was very happy to move in, but big home and also security, and did she feel comfortable in a big house by herself? And she was sort of going to give it 3 to 6 months. And then if it didn't work out for her, she'd probably go back and rent something that's a little bit more convenient for her, and she feels a bit safer in maybe a smaller, townhouse community as opposed to this big house.
Yep.
Perfect example.
Absolutely,
and at that time, it
allows
to
another 6 years of CGT exemption.
But I think the message for the listeners listening to that story is have a legitimate move back in strategy, not the old first home buyer moving in the house strategy. So you can qualify for the first home owners grant where you get your mail redirected and you've got a legit, because at the end of the day,
it's a big one. So the tax office will be sniffing around on that one.
And at the end of the day, someone from the tax department is going to look you in the eye and say, justify.
Yeah.
You've claimed.
Yeah, the onus is on the taxpayer to prove everything. And if the tax office aren't sufficiently happy, then they're going to just rule against you.
Yeah. And here you go. And here's a little fine, as well as here's what you need to pay us back.
Fraudulent activities.
And here's your orange vest that you need to wear for the next 10 years.
Removing graffiti.
And you can only see daylight for a couple of hours per day. Mate, the most common questions that come up for us, I'll put my BA hat on here, is I charge a BA fee.
Yes.
And almost, exclusively the number one question is that BA fee deductible? And sadly for me, the answer isn't to their satisfaction. But why is a buyer's agency fee not deductible?
Well, it's deemed to be a pre-purchase cost, so you actually haven't taken ownership of the property at that point. You're still in the process of sourcing
due diligence
diligence, sourcing the property and out about looking for it, and therefore it's a cost that's incurred to acquire the property, not in generating the actual income. Everything needs to be tied in with, from a deductibility perspective, it needs to be tied into the income. So you can't argue that the rental income is dependent on me getting a buyer's advocate fee.
Yep.
There is a component of the buyer's advocacy fee which relates to sourcing a rental agent.
Sometimes some buyers agents will interview property managers. In our business, we do that.
That portion of it is deductible because that's deemed to be, in the course of generating the income from a rental perspective.
Can you state a case for a sophisticated investor? Let's paint a scenario. They've got a multi-million-dollar portfolio. They've got numerous properties, and for them to achieve their income-producing goals, they need to buy more property. Mm-hmm. So therefore, to do that, they need to engage a buyer's agent. Mm-hmm. Could you draw a long bow?
Very long bow.
Because it's kind of like the same. It's the same one as a block of land. Because I've heard it before with a block of land, no income on it, so not deductible. But one of the accountants was.
Sorry to interrupt you though. When we say not deductible, it's not immediately deductible, so not allowable under Section 8-1, which is your normal general deductions. So it doesn't come out in your tax return straight away. It just gets added to the cost base of the property, and therefore impacts when you sell it. So capital gains tax. So your costs aren't getting completely lost.
Well, it's kind of one of those ones
about
about
a black hole.
Whether or not you want to be too cute or not. Because I've spoken to an accountant before who's got a high profile and says a block of land in a portfolio when you've got a number of properties forms a cornerstone of being able to buy other properties. Therefore put a strong case that the interest is deductible.
That sounds, without obviously knowing the
Disclaimer.
That they're in the business of buying land.
So hence my point, if you're in the business of buying property, so you're a sophisticated property investor, could there be a case?
Possibly.
But
I'd have to look at each individual.
Do we get into the area of GST? Because I mean, if you are in the business of that,
Absolutely.
So a lot of people...
It becomes a business.
Correct, because property is deemed more of a hobby activity than potentially a business activity. So if you're developing a land or building some townhouses and so forth, if it's a one-off, the tax office can probably say, oh, well, that's a hobby activity, as opposed to, well, no, this is my 14th development. There's going to be obviously GST.
With those kind of things, it always revolves around sophistication of investment and, how you're keeping your books and all that kind of stuff.
Because, I mean, one of the big things that everyone says, why aren't they deductible? And I say, well, guys, financial planning advice isn't deductible. Mm-hmm. So the government have made it clear, and the tax office made it clear, is the only professional deductions usually come out of property managers and obviously accounting and tax advice, which I think is really, really smart. Because I suspect the reason why they don't make financial planning advice tax deductible is people will rort the system.
Absolutely.
They'll sit there and then the financial planner will say, yeah, that's $50,000 worth of services, to try and so they just can't trust. Australians, can they? The tax office, they just don't trust us. Are you listening, ATO?
What about a couple of curly ones? The stamp duty and buyer's agency fee are deemed to be capital costs, therefore not deductible, but the interest on the loan for those items are deductible.
Yes, so it all comes under the same umbrella as essentially purchasing the property, so all your capital costs are purchased. You buy the home, the borrowings that you incur on buying that home, they're deductible, so the same thing applies to the stamp duty and the buyer's advocate fee. You can borrow to buy it, and the interest is deductible. It comes under the same umbrella.
So if I can unpack that, if I take $100,000 deposit, which is an after-tax money that I've saved, and I put that in, and I have a loan-to-value ratio of 70%, technically I've got to determine what portion of the loan amount, what that money was used for.
Yes.
And so that could have been used for stamp duty, could have been used for buyers, and the other was just to pay down or to pay the deposit or part of that. Now, if I'm doing 105% lend, which is basically releasing equity on my current home and investing in a property, or it doesn't mean current home, it can be another investment property. So I'm releasing equity and I'm doing 105% loan. Effectively, all of the interest that's being incurred on that, or 106 depending on the cost base, all of that's tax deductible.
Absolutely.
Yeah. Okay, great.
Because I had a client the other day said, but I've paid for my depreciation schedule and my landlord insurance before settlement, so therefore is that not deductible? I said, yeah, it is. So I think that the line in the sand for always thinking is, can this expense be incurred in income producing activity or prior to income producing activity?
Absolutely, yeah, and whether it's attributable to the income producing nature.
Very good. Well, 30 minutes always flies on the couch here, and we certainly appreciate you giving up your time. Hopefully that's been some really valuable insights for our listeners. Some of the common questions we often get, Ben.
Yeah, it is. And so, a little plug, Frank. So what's the accounting practice called?
YK Partners. We're in West Melbourne.
West Melbourne. So, and tell us a little about the business.
We're a 3-partner firm, and we're just...
how many accountants in total?
5 under us.
5 accountants. Great. So nice little boutique firm.
Small firm, and we're just out and about trying to drum up the business and grow as we can.
And the reason why we like these guys is they also have been active property investors on their journey as well. So they, I've always said, and they're Melbourne based. So if you're looking for an accountant in your local area, the first thing I would ask them is, are they interested in property investment? Do they have an investment property? So, because there's a funny thing that happens when there's a vested interest for the individual to know what they can claim, what they can't claim. There's usually a pretty good outcome in regards to them knowing all of the levels of claims that they can make. So,
absolutely. One
of the little things I say, are you actively investing in property? And if they are, that's a bonus. I'm not to say that every one of the partnerships in YK Partners are investing in property, but it was certainly a starting point for us, in terms of when I started dealing with Clinton many years ago.
Very, very good, Ben. I'm a degree qualified accountant myself. I don't know if you know that.
No, I didn't know that.
I don't say that too often because I was starting to use my personality as contraception. So, but that doesn't apply to all accountants. It was just me.
You knew that was coming.
It was just me. I had that written down. Ready to go.
We were going to pick on you.
But before we came on air, you gave us a real nugget of gold, and I think it's really important that we share this with our listeners. In terms of the stamp duty not being deductible. There is an exception, isn't there?
There is an exception,
and
yes.
we only found this out 20 minutes ago. So this is a real piece of gold.
Well, yeah. So ACT, so Canberra, because when you're buying property there, it's under a 99-year Crown lease. So you're buying the
it's a territory, so it's not a freehold; it's a leasehold.
Yeah, leasehold. So the stamp duty and the buyer's advocate's fees are deemed to be a straight tax deduction.
So watch everyone rush to Canberra. Canberra's just picked up inquiry levels by about 10%.
Google buyers agents in Canberra and then give it 30 days and you'll see that it's just tripled overnight. So there you go, folks. There's a little tip for you.
For the increase.
Yeah, that's right.
I did not know that. So there we go. Canberra has tax deductible opportunities.
And interestingly, if I'm reading the lay of the land, or I read somewhere recently, they're taking out their stamp duty, so they're phasing out stamp duty on property
in Canberra.
Yeah, I'm pretty sure that's the case. Don't quote me on it 100%.
Can't they do that in Melbourne?
Oh,
Can't they do that in Brisbane?
Well, there's a few things we'd like to see them, get rid of, which they were supposedly promised to get rid of. And remember the GST discussions between state and territories? It was like, yep, you can't do that if you. When we give you the revenue from GST, that means all of your stamp duties have got to go.
Yeah.
It didn't quite happen. I wish they got rid of payroll tax, and I wish they got rid of stamp duty. We got rid of some little small ones, such as stamp duty on share transactions and mortgage stamp duty. But don't worry, they need their revenue, this little government.
Absolutely.
There you go, folks. Some really great insights, and hopefully you can be the first to share it with your friends that Canberra has a little anomaly regarding the buyer's agency fee. So, mate, thanks for coming in.
You're welcome.
You're always welcome on the couch. Hopefully that's answered some common questions that we often get from clients. Obviously, the first one was structures. Second one was the principal place of residence rule. Third one was the Hart Case, which was the capitalising interest. And then we obviously talked about a few of the, the more common questions we get. So, mate, very, very insightful. Great. Now, this is the point.
I reckon we'll get you back.
Good. I think we will too.
I think we've got more tax questions to come through. There's a lot coming on there. So if you've got a tax question, we'll get Frank back later in the year
to answer those for us. Now, this has become comical, this part of the podcast now.
Yeah.
Because last year...
to be honest with you, everyone fast forwards to this bit. They don't care about the property content.
They don't.
They just care about...
They fast forward past our sport chat.
sign off.
And they fast forward to the sign off. But last year, we put out a call on whether we'd get rid of this, and the overwhelming call was to not. So you're about to see why.
Do you know I actually logged on and voted no?
So did I. There we go. All right, folks. So until next week, mate, where are we signing off this week?
Swahili.
Swahili.
Right?
This will be good. It will sound French, but it'll be Swahili. Here we go.
Kwahili. And I don't know whether the K is silent or not. If it's not, it's Wahili. But if the K isn't silent, it's Kwahiri.
There we go, folks.
Kwahiri.
Until next week, Kwahiri. Have a great week. See you guys.
Bye.